In 2004 and 2005, Michael Burry identified discrepancies in the mortgage market, realizing that the subprime market was overvalued. The real estate market is going to crash, and predicting a housing bubble and the impending collapse of the U.S. economy, Burry, a hedge fund manager at Scion Capital, shorted the market in 2007, making over $100 million. If you are watching the news, you will see predictions for 2024 of recessions, market crashes, and crises in general. Now let's be realistic to most people. Crises are bad. You lose your job, you might lose your clients, and overall you wish that things would return back to how they were before, but to the rich, to people who know how the system works, and to smart investors, a crisis is like a blessing that happens once in a decade, providing you with an opportunity to make more money in a single year than you would in a decade. Here in this video, we're going to look at 4 ways to make a fortune during crisis. The Big Short. While many know the conventional stock market strategy of buying low and selling high, short selling offers an alternative. This method involves borrowing stocks, selling them at the current price, and profiting when the stock value drops. Although risky, it can be lucrative during crisis times, as exemplified by Michael Burry's successful shorting of overvalued tech stocks during the dot-com bubble. That Apple stock is valued at $100, and you anticipate it dropping to $60 soon due to various factors. Here's the process for earning money. You borrow the Apple stock from a broker and sell it at the current $100 price. For you've just earned $100, suppose in a month your forecast is accurate, and the stock plummets to $60 with the initial $100, you buy back an Apple stock for $60 and return it to the broker from whom you borrowed it. Now you're left with a $40 profit without having invested any of your own money. According to Bloomberg, short sellers collectively earned above $50 billion in this downturn when the bubble burst in 2001 and the S&P 500 dropped by 11.88%. Michael Burry's hedge fund Scion saw a 55% increase by shorting overpriced tech stocks at the height of the bubble. Burry achieved these results the following year. With the S&P 500 down by 22.1%, Canon again outperformed, gaining 16%. 2. The magic of the Fed. The Federal Reserve plays a crucial role in managing economic downturns by adjusting interest rates. This is often achieved by either reducing or hiking interest rates in times of recession or crisis. The Fed, like any central bank, slashes interest rates to a minimal level, occasionally hitting 0% or even dipping into negative territory in this scenario. Banks might actually pay you to take out a loan. Sounds unbelievable, right, to some. However, during periods of economic distress, people tend to hoard their cash, hesitating to spend or invest. Negative interest rates serve as an incentive for people to start spending again, helping to reboot the economy. Here's a brilliant strategy for multiplying your wealth. Use these cost-free loans. It was essentially interest-free. Some individuals even leverage these loans to invest heavily in the stock market when prices hit rock bottom. Then, when the market recovers, they sell off their investments, settle their debts, and keep the profits. It might feel somewhat cutthroat, but in the business world, it's all about survival. You must continually strive to maintain your position, or else risk being overtaken by competitors or innovative startups better catering to your customers' needs. However, a major downside is that the majority of less affluent. This situation provides an opportunity to leverage cost-free loans, allowing savvy investors to acquire struggling competitors or invest in the stock market. The goal is to gain a larger market share and repay the loan when the economy rebounds. 3. Find the new trend. Inspired by the 2008 financial crisis, entrepreneurs created innovative solutions like Robinhood, a commission-free trading platform. The crisis prompted a shift in mindset, encouraging individuals to explore new ways of generating income and investing, leading to the rapid growth of platforms like Robinhood. The CEOs of the companies that went bankrupt left with bonuses that reached hundreds of millions of dollars. People at the bottom realized the importance of investing and having other sources of income besides their job. But in this complicated world of the stock market, it seems like an average person is more likely to lose money than make it on top of that. Brokers weren't cheap to make a deal and buy some stock. You had to pay your broker $5, $10, or $15. Of course, if you're making tens of thousands of dollars, that's not a big deal, it's peanuts for you. But for amateurs who are just starting with as little as a few $110 per trade is a lot. Vladimir 10V and BYU Bart realized, inspired by the events of 2008, they came up with Robinhood in 2013. They founded the company and announced that Robinhood was going to be a commission-free trading platform where anyone can pull out his smartphone and start investing. With as little as a few dollars, it was a revolution. It inspired a new generation of investors, encouraging people to put their money in the stock market. Robinhood began to grow tremendously year after year. The number of users hit a new record in its last round of raising funds. It was valued at $8.7 billion. Today, it's probably even higher. It turned its founders into billionaires within a few years. 4. Leveraging technology and digital transformation. Crisis accelerates technological adoption, presenting investment opportunities in companies that address evolving needs. Investors can either support existing companies leading these changes or develop their own solutions. For instance, the COVID-19 pandemic highlighted the importance of remote communication tools, e-commerce, and digital health solutions, leading to significant investments in these sectors. Technology and digital transformation crises often accelerate technological adoption and innovation, as businesses and individuals seek new ways to navigate challenges. The rich understand this and often invest in or develop technology that addresses these evolving needs. Technologies one crucial, for example. The COVID pandemic highlighted the importance of remote communication, tools, e-commerce platforms, and digital health solutions. Wealthy individuals either invest in companies that are leading these technological changes or develop their own solutions through startups or partnerships. For instance, during the pandemic, investments in remote work, technologies, telehealth, and e-learning platforms soared. Technology allows for rapid scaling to meet the increased demand during a crisis. Companies that can quickly adapt and scale their solutions often see exponential growth. Once the crisis subsides, many of these technological solutions will become ingrained in everyday life. For example, remote work tools like Zoom or Microsoft Teams became essential during the pandemic and have continued to be widely used even as workplaces reopened. Technologies like AI and big data analytics enable businesses to make smarter, data-driven decisions. This is particularly useful in times of crisis. When market conditions are volatile and unpredictable, automation also helps in reducing operational costs and maintaining efficiency especially. The stories of Michael Burry's strategic betting against the market, the founding of Robinhood by 10V and BAT, and the rapid adoption of digital technologies in times of need all share one common thread. These aren't just about making more money. They're about seeing things differently when everything seems to be going wrong. Thank you so much for watching our video. If you enjoyed it, please give it a thumbs up and consider sharing it with your friends. Your support means a lot to us. Don't forget to leave a comment below with your thoughts. We appreciate your feedback, and it helps us create even better videos in the future. We'll see you in the next video.